Hi everyone, it's Mike Bonn of the Cash Flow Company. Today we're going to go over something near and dear to my heart because I see it impacting more investors than anything else, and that's credit scores. How credit scores affect rates and your terms, and we're going to go over 3 real examples from DSCR to fix and flip to even equity that's in your property or properties you own free and clear. Credit scores matter. Leverage is king in real estate investing. That's where wealth and income is created. The number one item nowadays is credit score. So let's look at just one way it impacts a fix and flip loan. Now these are numbers from a client who approached us to do a second or gap funding loan. And it was interesting just to look at how her loan was set up compared to someone with a little bit better score. With this example, we're just going to use 660 as a low credit score and 740 as a high credit score. In her case, in a fix and flip, she was buying a property for $525,000 and she needed $85,000 in repairs. If you look at the numbers based on her credit score and someone who has a little bit better credit score, you're going to see where credit scores impact how much money you have to put into the project. In this case, it really didn't impact the rate because here's what lenders do. They just give you less money from the loan that you have to put into the project. So in her case, the lender said, hey, we're going to give you the same interest rate, 11.49, 1 point, but we're only going to give you 85% of the purchase price. So in this case, if she's buying it for $525, the lender's only going to lend her 85% of that. That 85% is $446,250. She's going to have to come up now with the 15% down. She's going to have to come up with the $85,000 for the rehab, plus any closing costs. So let's estimate those closing costs at $7,500. What you see now is she's going to have the loan for the $446,250, but she's going to have to bring in over $171,000. It's hard to do multiple projects when you have to bring in that much money. Now let's look at someone who has a 740 score going with the same lender. The lender now opens up their options and they can lend them 85% of the purchase, that did not change, but also 100% of the rehab. So they're going to add $85,000 onto what they do for this borrower with good credit compared to someone who does not have the best credit score. Credit score impacts you not only in rates, but it also in terms. Terms meaning how much they'll lend you. Now, since a lender could lend up to 100% of the rehab with a better credit score, we're going to compare the two loans. Borrower 1 with a lower credit score only got to $446,250. Borrower number 2 with a better credit score gets $531,250. $85,000 more than borrower number 1. That's a big number when you're not only looking at one project, but what if you're looking at multiple projects? So credit score impacts not only the rates you get in sometimes, but even the terms, making it harder to get into and keep fix and flips going because you can't keep all that money tied up into each project. So credit score matters when you're doing fix and flips. It may not always be the rate, but it a lot of times is the rate and points, but it's also the terms, how much they're going to lend you and how much you have to come out of pocket. Now we looked at a fix and flip. Now just say you're someone who invests to rent and you're looking at something like a DSCR loan. How does credit score impact you in the DSCR? Here's an example. Let's just look at cash out refinances because it's something that comes up a lot and people are looking to get cash out to buy more properties. So if you have a 660 score and you can find a DSCR lender who will actually lend to you, you're looking at best of cash out of 65%. Now let's just look at an example. Let's just say we have a property that is appraised for $350,000. We have someone who has a 660 credit score again and someone who has a 740. The person who has a 660, number 1, is going to get less money out. So they're going to be capped out typically at 65%. So with someone with a 660 credit score, a value of $350, they're going to get a loan for about $227,500. Now, if you have a 740 credit score, you could get 75% pretty easy. Now, instead of $227,500, you could get $262,500 or $35,000 more cash out. So just because you have a better credit score, you're taking investing seriously, you get more money out. And that's an advantage for most people. But let's look at what else happens here. So the person with a lower credit score gets less cash out. But guess what else happens? Their rate is higher. So in this case, the rate of 9.75 on a 30-year fix, meaning they have payments that equal $1,955 on that $227,500. Now the person with a good credit, remember with the $262,500, they're going to get a better rate. Today's rates are right around 8%. They got more money out. Remember, they got $35,000 more than the person with low credit score, but their payments are actually lower. Their payments are now $1,926 and some change. As you can see, it's not a big difference in payments, but guess what? It's a lower payment, and they got $35,000 out. Now, if you take this and it's investors doing long-term investing, and they paid this over 30 years, the person with the lower credit score and the lower amount of a loan actually pays more over those 30 years than the person with good credit with a larger loan and a better rate. So if you're serious about investing, credit score matters. It doesn't matter if it's a fix and flip or DSCR. Now here's something that comes up a lot. We have people who come to us with free and clear properties. We have people who come with portfolios or even single, and they say we have a lot of equity. Of course, the people who have free and clear properties have a lot of equity. What are our options? How do we get lines of credit? How do we use this equity to advance our real estate career? And the biggest question, number one, is what is your credit score? Because a person who has a free and clear property but doesn't have good credit is limited in their options. Typically, their option is a short-term loan, bridge loan with a hard money lender. Now, that same person with that same property goes and has a 760 credit score. It opens up more options, lines of credit, HELOCs, bridge loans. You could use that property for so many things depending on your real estate needs. Even if you're talking about equity, maybe you have some properties and there's a ton of equity, maybe you have 40 or 50% equity in properties. You have options when your credit score is good. You have very little options, if any, when your credit score is low. If you're serious about real estate investing, you need to keep your credit score up. The higher the credit score, the easier, the cheaper, the faster the leverage. As you can see here, it's going to cost you over time, not only in being able to do deals, because you have to put more money into each deal, but also your cash flow. You're going to get less from each property than someone with a good credit score. So make it easy for you. Get your credit score up. If you're looking at ways to increase that credit score with either usage loans, credit card strategy, or just tips, reach out to us at Mike at the Cash Flow Company. We'd be glad to help you. We understand with working with a lot of investors that your credit score is affected by certain things like credit score usage. So if you're looking at getting that fixed so you can start getting the better rates, the better terms, all those things, reach out to us. We'd be glad to help you. Also check out our website, thecashflowcompany.com. We got a lot of free tools out there just to help you. And we'll see you on the next video.